If you look at the data, the average investor consistently makes less than half the money that they should. The reason for this shortcoming is partially because the industry gives people bad advice. But the bigger reason is that people don't understand how stocks work. If you want to know some really insightful data about stocks and investing, this video is for you. Hello, I'm Pat Zumbush, your YouTube CFP. The purpose of this video series is to truly help people succeed financially. If you like what you hear today, be sure to give it a thumbs up and send it on to your children or someone that you love to help them. In my opinion, you can't succeed at something you don't understand. Since investing in stocks is a key step to being financially successful, we should help people understand the truth about stocks, also called equities, so that they do the right things. Today I'm going to address the top 6 most important concepts to understanding and then using the knowledge of stocks at a very high level. If you understand it, given all the research done in this area, I do fairly objectively state that you will double your wealth compared to people who don't know. Each of the 6 items could take a 3-hour session to explain, but I'm going to do all 6 in 3 minutes, so hold on. Number 1, stocks go up 8 to 10% per year. Bonds make annual returns of 4 to 6%, and cash makes 3%. Everybody wants the 10%, but they screw up on how to get it because they don't understand the next 5 points. Number 2, in this world, you don't get anything for free. This reality applies equally with stocks. If you want 10% annual compound returns, which is powerful growth, you have to give up on something in exchange. In the finance world, what you give up is short-term stability. In finance terms, we call lack of year-to-year stability the standard deviation of stocks, commonly referred to as volatility. This volatility is such that stocks may go up 10% long-term, but year-to-year, they go up and down 18 to 20% on average. Number 3, on individual stocks themselves, buying this symbol or that symbol, people think they know how to pick winners. Sometimes we pay people to pick those winners for us and put money into their funds for their mystical insight. In finance terms, these steps are called security selection or actively managed funds, and both strategies have a high probability to fall short of what you deserve if you look at all the data. We'd be far wiser to admit that we don't know which stocks will go up or down. Thus, the best way to get the average 10% is to buy all the stocks, and the winners will outpace and naturally outweigh the losers. The long-term preponderance for stock to be increasing in value will happen, or the world as we know it will come to an end. And if the world comes to an end, you have a lot bigger problems than your stocks anyway. Number 4, your stock and bond mixture is called your asset allocation. Your asset allocation determines 92 to 98% of all the volatility in your portfolio. If you want more return, have more stocks, or said differently, have a higher asset allocation. If you do, and it's fine, just realize that you will naturally have to stomach more volatility. There's nothing wrong with it, but you can't go nuts when volatility happens. Which leads me to number 5. Most people do go nuts and make mistakes on investments. If you look at investor returns, we don't buy low and sell high. We do the exact opposite. People say that this bad behavior will never happen to them, but that's not true. People consistently panic or jump from some losing fund to some other fund that's doing well, which means we lack discipline and we're chasing returns. We say to ourselves, it's different this time. The truth is that it's never different. Markets go down and they go up, but as human beings, we get greedy or we panic. This brings me to my final point, number 6. People need to think of volatility as their friend, not their enemy. Volatility gives you those long-term 10% annual returns, and you use that volatility to buy low and sell high. You accomplish this great feat of genius by rebalancing your account. Rebalance your account on a very special day so that you don't forget. Say your birthday. If you rebalance to your asset allocation every year, you will inevitably buy low and sell high. It is impossible for anyone, literally anyone, to know where the market will go next week, next month, or even next year. Thus, if you rebalance on a disciplined basis, such as once per year, you will take advantage of market drops to buy when stocks are cheap, and you will sell them when they're dear. You're going to look like Einstein. Those are the 6 pieces of key knowledge you need to succeed and be a great investor in stock. Doing the above pieces regimentally is like assembling a puzzle of success. Completing that puzzle will by itself ensure you that you beat 70 to 80% of all investors. It's wickedly smart advice in simple terms, so put it into practice and change your life and the life of those around you. With that reality, I conclude this important session. As always, thank you for letting me help you do wise things with your money.